Hi, welcome to the Crypto Republic. Before we begin today, if you're serious about staying ahead in this once-in-a-lifetime financial shift, make sure you like this video, drop a comment, and subscribe to the Crypto Republic. Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest energy updates and digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to the Crypto Republic, bringing you updates every day at 9 a.m., noon, and 7 p.m. Eastern Standard Time. And here at the Crypto Republic, we give you the bird's eye view, a satellite perspective to spot the big picture shifts while everyone else is stuck in the daily chaos. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. Something doesn't fully line up with XRP right now. And I don't mean that as a headline. I mean there's a real disconnect between what the market is reacting to and what may actually be developing underneath the surface. If you've been watching the last 24 hours, you've seen the noise, bold claims, half-truths, nonstop opinions. But behind that, there are signals that deserve a closer look. And that's the part most people are missing. The chart is moving. The narrative is moving. But the deeper story may be moving in a different direction. So the real question isn't just what XRP is doing. It's whether the market is looking at it through the wrong lens entirely. I just want to take the time to thank everyone that likes, subscribes, shares, and comments on our videos. These few things really do help out the channel grow very much. And with that being said, I hope everyone enjoys the content. Let's dissect this. What's going on, Wolfpack? Today we're breaking down why something around XRP doesn't fully make sense right now. On the surface, you have fear, confusion, and constant commentary. But underneath that, you also have institutional signals, regulatory movement, and infrastructure development pointing somewhere else. And when those two don't line up, that's when you slow down. That's when you pay attention, because that's the real question, which is simple. What actually changed? And what just looks like it changed? There's a lot of noise in crypto right now, and noise is expensive because it doesn't just distract you. It distorts how you see what's happening. Scroll long enough, and you'll see every opinion possible. That's not analysis. That's reaction. And this is where most people lose the plot. They react to the loudest narrative instead of the strongest signal. Now, here where it gets interesting. Even jokes, viral posts, or quick takes can shape perception. And if you're not grounded in the facts, those things start to feel real. But markets don't just move on facts. They move on what people believe the facts are. That's why you need discipline. Now, let's talk about something that actually matters. Ripple receiving an investment-grade BBB rating. That's not normal in crypto. That's a signal. In traditional finance, that reflects credibility, execution, and trust in the business model. So when you see that applied here, you have to ask, is this still being treated like a speculative asset or something closer to infrastructure? Because those are very different things. Now go a level deeper. Ripple didn't just show up. They built relationships across banks, payment systems, and institutions globally. This didn't happen overnight. And it's not just testing anymore. It's expansion. And when networks reach that stage, something important happens, the network effect. The more participants involved, the more valuable and harder to replace it becomes. That's how infrastructure works. But here's the part most people don't see. A lot of real progress doesn't happen publicly. It happens quietly, inside systems, inside testing, inside planning. So if you're looking only at headlines, you're only seeing part of the picture. And historically, that's where opportunity starts to form, when your perception and reality don't fully match. Now let's bring in regulation, because this is a major piece. Institutions don't move without clarity. They need to know what they're dealing with. And that's where things like the Clarity Act come in. Not as hype, but as structure. Because rules unlock participation, and participation is what drives scale. For XRP, this matters even more, because uncertainty has been a major weight. Remove uncertainty, and you reduce friction. And when friction drops, systems can actually be used. Now zoom out again. The market right now is reacting to macro pressure, geopolitics, inflation, energy. That creates risk-off behavior. And when that happens, everything moves. But that doesn't always mean something broke. Sometimes it just means the environment shifted temporarily. Let that sink in. Then add leverage. Liquidation hits. Selling accelerates. Moves get exaggerated. But that's mechanical, not always structural. So now you have two things happening at once. Short-term pressure, long-term development, and those don't always move together. So here's the real takeaway, ladies and gentlemen. Something doesn't fully line up with XRP right now because the surface story and the underlying structure are telling two different things. Price is reacting, but the system is still evolving. Short-term noise, long-term structure. And if it confuses one for the other, you miss the bigger picture. If you got value from this, hit the like button, subscribe if you're part of the wolf pack, and drop this below. Do you think the market is missing something here, or is it price already telling the full story? I want to hear your take. Well, ladies and gentlemen, I hope everyone's enjoying the holiday weekend. Happy Saturday. Some big things to go over right now. Coming out of SBI, a bold call. XRP will be very expensive. Japanese financial giant makes a bold claim. SBI's big doings with XRP. Ladies and gentlemen, you don't get some kind of comment like that unless something's seriously cooking underneath the hood, you know? So you got to realize there's a lot of things happening right now. And it's amazing when people don't understand all the things that are moving at once. And when you pay attention with your recce, your plan, and you drown out the noise, it tells something very, very different. Ask yourself why a massive conglomerate would say that. If that doesn't add to your Gucci perception, Gucci clarity, I don't even know what to say. But there's so many things happening right now, and it's unbelievable. I want to thank everyone. I'd like to thank all the new members of the Patreon, all the new members of the membership channel. Welcome. I want to discuss something right now that really, really is blowing my mind. And I want you to take a look at this through our lens, how we discuss this with institutional clients, family offices, funds, sovereigns. This is not financial advice. This is just our opinion. And I want you to understand what we see and why. And the entire narrative about the Middle East, about the supply disruptions, it's got a lot more meat on the bone than most people are discussing. And this is exactly what I'm talking about. One good tip from the pits can easily pay for your entire year subscription. If you want the deeper macro research and more importantly, how to actually position around all of this, do come and join us. We're approaching 500 active traders, investors inside the Crypto Republic Desk monthly. And welcome all the new members. But here's the part that frustrates me so much. Most people think what's happening right now is new. It's not. It's just become impossible to ignore. We're watching the slow rewiring of the global financial system in real time. And if you're only looking at headlines, you're missing it. Here's what actually matters. The petrodollar isn't breaking. It's being replaced piece by piece. Oil is increasingly being traded outside the US dollar. The Middle East is shifting towards Asia, where demand is growing. New systems are being quietly built. BRIC-style payment rails, mBridge, CBDC cross-border settlement systems, early-stage commodity-linked development concepts, the unit. This didn't start this year. It started over a decade ago. But now, it's accelerating. Let this sink in. Again, the dollar has two pillars, ladies and gentlemen. Both are under pressure. Petrodollar energy markets, Eurodollar global liquidity system. Both are weakening for different reasons. Europe is drifting from U.S. systems. Payment rails are being used as leverage. Stable coins are quietly building alternative liquidity layers at the same time. Countries are actively reducing dependence on the dollar, not all at once, but steady. The trigger most people aren't thinking about is geopolitics. If conflicts expose even the perception that the U.S. won't fully support certain regions, that's enough. Markets don't wait for confirmation. They move on perception. And what happens leads to more oil gets traded in other countries and currencies, leads to more countries hedge away from the dollar exposure, leads the system slowly shifts underneath everyone. The data already confirms the dollar dominance in trade is declining. China now buys far more oil from Saudi Arabia than the United States. The U.S. is becoming energy independent. Think about the last one. If the U.S. needs the Middle East less, leads it cares less. And that changes everything. So here's the reality, no hype. This is not a collapse. This is a transition, a move from one dominant system to multiple competing systems slowly, structurally, inevitably. Ladies and gentlemen, what this means for you, most people will wake up after this is obvious. By then, positioning is already done. Inside here, we're not reacting. We're tracking it early. We're breaking it down simply, and we're positioning ahead of the narrative. It's this kind of breakdown helps you see the market clearer. The deeper tits from the pits drops you even further in where capital is actually moving, how to position ahead of these shifts, what signals matter, and what's just noise. Because one good tip, one good insight can cover your entire membership, ladies and gentlemen. You got to understand this. There is so much happening right now that I don't even know how to describe this. I keep going over and over about things. And we're going to discuss right now the changing world because it's really changing. And I'm going to slow this down and really, I guess this is our holiday weekend special. And if you made it here, I salute you because you're going to see my Gucci conviction, my Gucci clarity, what we're paying attention to. So as always, write these things down because this is free. And this is why I keep saying most people are missing the edge. They really, really are, okay? This is my institutional take on how the Iran conflict is reshaping commodities. Not financial advice, just my opinion, and anyone that retains any capacity, okay? This is not financial advice. But as the remora, here's my Gucci conviction. And as a financial mercenary, this is what I pay attention to. So from where I sit, the geopolitical shock coming out of Iran has clearly rattled commodity markets. But when I zoom out and I address the underlying structure, the bigger picture has not broken yet. In fact, in several areas, it's strengthening. Yes, we've seen sharp reactions, particularly in oil and gas, but I view those as initial shock responses rather than a change in long-term direction. Write that down. The structural drivers behind commodities remain firmly intact. Gold, volatility first, then opportunity. Write that down. Gold has been the most telling signal in this environment. We saw it pull back aggressively from above 5,400 early this year to nearly 4,200 as its low, before rebounding sharply into the mid 4,600s. We had told everyone to sell around 4,500. If you did, I salute you. That kind of volatility isn't random. It reflects a market trying to reconcile two competing forces, liquidity demand and structural distrust in fiat systems. So historically, gold tracked closely with real yields, particularly U.S. 10-year tips. That relationship held for years. But after the Russia-Ukraine conflict and the freezing of Russia dollar reserves, that dynamic broke down and got cut up like sushi. From that point forward, I've been watching a different driver take control. Central bank behavior, especially outside the Western systems. Countries like China, Russia, and Turkey began accumulating gold, not based on yield dynamics, but based on geopolitical risk. So in other words, gold became less about interest rates and more about sovereignty. Now, with the Iran conflict unfolding, I'm watching closely to see whether gold reverts back to its old correlation with rates or if it breaks away again. My view is that this tension will keep gold highly volatile in the near term. Not financial advice, just my opinion. But if history is any guide, the setup becomes clearer. During both the pandemic and the global financial crisis, gold initially sold off down roughly 7% early in COVID and nearly 20% in the first phase of GFC. The reason was simple: a global scramble for liquidity. Investors sold what they could, including gold, to raise U.S. dollars. We're seeing a similar pattern now. The dollar strengthens early, gold gets hit. But over time, once the panic phase passes and policy responses emerge, gold tends to outperform. Let this sink in. This cycle flows that same trajectory. I expect gold to perform strongly over the next 12 months. That said, there are short-term pressures. We're seeing sovereign levels liquidity actions, gold swaps, export restrictions, particularly from countries under economic strain. That can create temporary headwinds. So if you look at macro pressures, inflation versus recession, one of the clearest risks I see right now is the knock-on effect from energy markets. Sharp moves in oil prices have historically been a precursor to economic slowdowns. And given the current spike, I think the probability of recession, both in the U.S. and globally, has increased meaningfully. So at the same time, inflation pressure is building again. This puts central banks in an extremely difficult position. They effectively trapped, forced to choose between controlling inflation or supporting growth. In many cases, they're choosing neither, opting instead to wait. So from my perspective, that hesitation is telling, and it's such an opportunity if you understand this and why. Again, the winner's emerging. Supply shock meets strategic demand. Write that down. Some commodities aren't just reacting, they're repricing structurally. Tungsten is a prime example. Prices have surged dramatically over the past years, driven initially by Chinese export restrictions. But what's more important now is demand composition. Tungsten has critical military applications, and that demand, while relatively small in perceptive terms, is highly price insensitive. So defensive buyers are now compensating directly with institutional users. And supply outside China is extremely limited. Even if prices pull back from extremes, I expect them to remain elevated for several years simply due to supply constraints. Write that down. These are free tips from the pitch, ladies and gentlemen. These are free. Again, aluminum, energy in solid form. Aluminum is another market I'm watching closely. Production disruptions in the Middle East have tightened supply, but the real story is energy. Aluminum is effectively stored energy. It requires enormous amounts of power to produce. When energy markets are unstable, aluminum pricing tends to follow on top of that. The supply chain is complex. Backside to aluminum is aluminum. Each step requiring transportation, processing, and distribution along that chain creates compounding effects. My expectation is continued upward pressure here. Again, these are free tips from the pits. Copper, short-term weakness, long-term strength. Copper is telling a more nuanced story. Inventories have been built and building, and prices have been softened already. If we move into a recessionary environment, demand from the consumer sector, which represents a significant portion of usage, will likely decline further. So in the near term, I expect continued pressure, but structurally nothing has changed. If anything, the long-term demand case is stronger than ever. Electrification, grid expansion, especially data center growth, all require enormous amounts of copper. You simply don't build the future energy systems without it. This isn't an energy transition, ladies and gentlemen. It's energy expansion. Write that down. One of the biggest misconceptions I see repeated is the idea of an energy transition. I don't subscribe to that framing. We don't. We are not replacing energy sources. We are adding to them. The world is consuming more of everything. More oil, more coal, more gas, even more traditional fuels like wood. New energy systems aren't displacing old ones. They're stacking on top. That distinction matters because it means demand across multiple commodities can rise simultaneously. We're already seeing renewed interest in nuclear energy as countries look for stability in an increasing volatile geopolitical landscape. Germany is reconsidering its stance, and others are moving to restart or expand reactor capacity. That trend, in my view, is only accelerating. This is a big one. Battery metals and electrification demand. At the same time, higher fuel costs are pushing renewed interest in electrification. Battery demand, particularly lithium, was already recovering before this conflict began. Now, with rising fuel prices and supply concerns, that demand outlook is strengthening further. Even if internal combustion engines remain part of the mix longer than expected, the direction of travel is clear. More electrification, not less. Here's some hidden risks. Fertilizers and food supply. The area that concerns me the most isn't metal, it's agriculture. We're paying attention to this one more than anything, ladies and gentlemen. This is big. The Middle East accounts for nearly half of the global urea production. With supply disruptions already pushing prices up significantly, we're now facing a potential shortage heading into key planting seasons. This is where second-order effects become critical. If fertilizers don't reach farms in time, crop yields decline. That feeds directly into food inflation and potentially food shortages. So from a market perspective, that's not just a commodity issue. That's a systematic risk. My final thought, not financial advice, just my opinion. Anyone retains any capacity? When I step back, ladies and gentlemen, I look across the entire landscape, the entire board, I don't see a commodity cycle breaking. I see one evolving under pressure. Short-term volatility is inevitable in a geopolitical shock like this, but structurally. Supply constraints, energy instability, geopolitical fragmentation, and long-term demand from electrification and infrastructure are still firmly in place. And in many cases, they're intensifying. That's the real story here, ladies and gentlemen. What this means for you, most people will wake up after this is obvious. But by then, positioning's already done. See, inside here, we're not reacting. We're tracking it early. We're breaking it down simply. And we're positioning ahead of the narrative. If this kind of breakdown helps you see the markets clearer, the deeper tips from the pits drops go even further. Where capital is actually moving, how to position ahead of these shifts, what signals matter, and what's just noise. Because one good tip can cover your entire membership, ladies and gentlemen. Do come and join us at the Crypto Desk monthly inside of our Patreon, and welcome all the new members. Ladies and gentlemen, I'm going to give you now, as a special bonus, if you're still here, I salute you on this holiday weekend. For all the loyal Wolfpack members who always make it to this candy part of the Italian ice, what institutional view on commodities amid the Iran conflict really looks like. If you write down everything I just went over and you start dissecting this, you have a playbook of where to look, ladies and gentlemen, not financial advice. As a financial mercenary, this is what I pay attention to every day. I don't pay attention to what's streaming on Netflix or Hulu or whatever they are. I don't pay attention to any kind of movies. I watch financial reporting in multiple languages, in multiple time zones, from sunup in Asia to sundown in Asia. I simply have to know what's happening because my livelihood and everyone that retains any capacity depends on it. Again, XRP, that news coming out of SBI is massive. I tell you this all the time. ICP, XRP, HBAR, the anointed ones. I tell you this again, but here's a special treat. The institutional view on commodities amid the Iran conflict. Ladies and gentlemen, this is not a normal market environment, and most people are not positioned for what comes next. That's the difference. That's the edge. And that's exactly what we focus on inside the Crypto Republic Desk Monthly, ladies and gentlemen. The key takeaways: gold is in a liquidity versus trust battle, short-term volatility, long-term bullish structure. Oil shock, increased probability of inflation and recession simultaneously. Central banks are effectively paralyzed, which is historically supported for hard assets. Strategic commodities such as tungsten and aluminum are entering supply-constrained regimes. Copper faces short-term pressure but retains strong long-term upside, driven by energy infrastructure demand. This is not an energy transition. It's an energy expansion. Fertilizer shortages represent an unprecedented global risk with potential second-order effects. If you only read one section, ladies and gentlemen, of this transcript, because I know I talk very, very fast, focus on this part of this transcript and why this matters, ladies and gentlemen. I always tell you to write this down. This is not just macro noise. It directly impacts asset prices, inflation dynamics, trade opportunities, and overall portfolio positioning. We're entering a phase where volatility creates opportunity, liquidity events create entry points, and geopolitics become a primary market driver. Those who understand this early position ahead of the move. Those who do not react late. We are in the cycle. We are not in a stable early cycle environment, ladies and gentlemen. We're in a transition phase between initial shock and policy response. This is typical where liquidity events occur. Volatility accelerates and mispricing is created. This is where the best opportunities are built, not chased. Ladies and gentlemen, this is where the edge is built. And at the Crypto Republic, we maintain a constructive outlook on commodities despite elevated geopolitical tensions. Again, the ongoing conflict involving the United States, Israel, and Iran has driven sharp movements in energy markets, particularly oil and gas. While some commodities have experienced short-term pressure, we do not view this as a breakdown in the broader thesis. The structural foundations remain intact. Gold has been central to recent volatility. After reacting levels above 5,400 early this year, it retraced towards 4,200 before rebounding into the mid-46 range. This type of movement reflects structural repositioning rather than random fluctuation. Historically, gold maintained a strong inverse relationship with real interest rates, particularly U.S. 10-year tips. That relationship broke down following the Russia-Ukraine conflict and the freezing of sovereign reserves. So from the point forward, central banks, particularly outside the Western system, including China, Turkey, and Russia, shifted their approach. Gold accumulation became less about rates and more about geopolitical risk. Gold effectively transitioned from a rate-sensitive asset to a trust-based hedge. That's so huge. With the Iran conflict unfolding, there are signs that gold may be attempting to reconnect with traditional macro correlations. The key question is whether their relationship will hold or break down again. So in the near term, volatility is likely to remain elevated. Recent price action suggests gold may already be attempting to break away once again, consistent with historical patterns. According to data from BlackRock, gold typically follows a recognizable sequence during periods of disruption. So in both the COVID financial crisis and global financial crisis, gold initially declined approximately 7% early in the pandemic and around 20% during the early phases of the GFC. This was driven by a global demand for liquidity. Investors sold liquid assets, including gold, to accumulate U.S. dollars. Similar patterns unfolding right now. The dollar has strengthened in the early phase of the conflict, placing pressure on gold. However, as those crises evolved, gold ultimately outperformed. This cycle follows the same structure, ladies and gentlemen. Gold is likely to recover and outperform over the next 12 months. At the same time, sovereign-level liquidity actions such as gold, swaps, and export restrictions are introducing short-term pressure as countries respond to economic strain. None of this is financial advice, just my opinion, ladies and gentlemen. Macro backdrop, policy gridlock, and rising rates. Energy volatility is feeding directly into macro conditions. Historically, sharp movements in oil prices have been associated with recession risk. Current conditions suggesting rising inflation pressure alongside an increased probability of economic slowdown across major economies. This creates a policy dilemma. Central banks are forced to balance inflation control against economic support. In the United States, Jerome Powell has adopted a cautious stance reflecting uncertainty. Yet many central banks are effectively waiting rather than actively decisively. This indecision has historically been supportive for commodities, winners and losers across the commodity complex. Write this down, ladies and gentlemen. These are free tips from the pits. Tungsten has been one of the most significant movers, rising more than 500% over the past year. It's risen more than 500% over the past year. This move is massive. That's why when we were positioning, when we told everyone we were watching before the first task force got to the Emmys, we were positioning for all of these. If you understand what I'm talking about, that's the difference of having unbelievable performance in a trading account and watching it from the sidelines. Positioning matters, ladies and gentlemen, before moves. Initial gains were driven by Chinese export restrictions, but the current driver is strategic demand. Tungsten plays a key role in defense applications. While military demand represents a smaller portion of total consumption, it's highly inelastic. Defense buyers are now competing directly with industrial users, tightening supply. Limited Western production capacity suggests prices may remain elevated over the medium term. Aluminum is also benefiting from current conditions. Production is energy intensive and supply disruption in the Middle East have compounded price pressure. Oil, often referred to as solid energy, aluminum reflects both material demand and energy cost dynamics. Its multi-stage supply chain further amplifies disruptions. Copper presents a more mixed outlook. Inventories were rising prior to the conflict, and recession risk may weigh on the short-term demand, particularly from consumer sector. However, the long-term outlook remains strong. Electrification, grid expansion, and data center growth all require significant copper input. Copper remains one of the most strategically important commodities in the global system. Energy reality, addition, not transition. The concept of energy transition is often misunderstood. Global consumption of oil, coal, gas, and other energy sources is increasingly as new energy systems are added. Demand is growing across all categories simultaneously. Geopolitical instability is also accelerating interest in nuclear energy as countries seek stability and independence in power generation. Battery, metal, structural demand. Fuel instability is supporting renewed demand for battery-related commodities. Lithium had already begun recovering prior to conflict with supply deficits emerging. That trend is now strengthening. Electrification continues to gain momentum, even if traditional energy systems remain in place longer than expected. Critical risks, fertilizer and flood supply, one of the most underappreciated risks lie in the Middle East and agriculture. The Middle East accounts for approximately 46% of global urea production. Supply disruptions have already driven prices and tightening availability. With key planting seasons approaching, fertilizer shortages could impact crop yields. This creates downstream effects, including food inflation and broader supply chain stress. So here's my final assessment, ladies and gentlemen. This is not the end of the commodity cycle, not by any shot. It's the next phase. The core drivers remain unchanged. Supply constraints, energy instability, geopolitical fragmentation, structural demand, growth. If anything, these forces are intensifying. How I'm positioning around this, monitoring gold for a post-liquidity breakout phase, watching oil as a key recession signal, tracking copper for weakness for long-term accumulation opportunities, focusing on supply-constrained commodities rather than speculative narratives, paying close attention to fertilizer and food supply dynamics. This framework reflects the thinking behind our tips from the pits approach. From analysis to action, this type of environment is where high-quality opportunities are identified, ladies and gentlemen, not from headlines or hype, but from macro pressure points, supply disruptions, mispriced narratives. These are the conditions where asymmetric opportunities begin to form. It only takes one well-identified setup to justify the value of being positioned early. What most people are missing, most market participants focus on circus-level narratives. What is often missed, the shift from rate-driven to trust-driven markets. The reality that energy demand is expanding across all systems. The second order effects of fertilization constraint on food and inflation. The largest opportunities tend to emerge from what the market is underpricing. Risk and area to watch. None of this is financial advice, just my opinion. If energy prices continue to rise, liquidity tightens further, and central banks remain inactive. The following risks increase: accelerating recession probability, forced selling across asset classes, elevated volatility. These conditions can create both downside risk and opportunity. This is not a typical market environment, ladies and gentlemen. The edge is no longer just access to information. It's the ability to interpret its correlation and position accordingly. One insight at the right time can justify an entire year positioning advantage. If you're here, you're early, ladies and gentlemen. And like I keep saying, one good tip from the pits can easily pay for your entire year subscription. If you want the deeper macro research and learn how to take advantage of all this, come and join the almost 500 active traders invested inside the Patreon, the Crypto Republic Desk Monthly. And welcome to all the new members. Ladies and gentlemen, enjoy the holiday. I love you all always. This content is for informational and entertainment purposes only. Should not be taken as financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Remember, the game is changing, and those who understand it first will benefit the most. Make sure you're on the right side of it. You have two choices. You can be like the crowd reacting after the move, rationalizing why they missed it, telling themselves they never let it happen again. Or you can be the one who saw behind the curtain, the one who understood the infrastructure shift, the one who positioned early, not randomly, but intentionally. Because some moments in history are loud, but the ones that change everything are quiet, right up to the moment they're not. And this is one of those moments. Do not blink, because the world is distracting you with noise, while XRP continues developing behind the scenes and building momentum in the broader digital asset landscape. Stay sharp, stay informed, accumulate knowledge. Your move now will be remembered. This is not the end of the story. This is just the beginning. This opened your eyes. Smash that like button. Ring that bell and leave a comment with your thoughts. Turn on notifications, and most importantly, subscribe to Crypto Republic. We break down the major global banking trends shaping digital assets today, giving you context, clarity. Don't just watch history happen. Stay informed, stay ahead, stay in the Republic. I love you all. Happy holidays.